Many people look at it and they think potatoes and hogs. Why would that trade on a sophisticated bourse like the JSE? Can it trade? Is it viable? And you're saying yes.
Lerato, thank you very much. Good morning. I think when we look at potatoes and hogs, those are interesting contracts, and I think South Africa has had the experience with potatoes. Back in '95, when the derivative market for commodities was established, we looked at a number of products, and potatoes was, yes, one of the original products. Unfortunately, it didn't work. When you look at a derivative contract and introducing it, there's a lot of standardization that you want. You want to be able to trade the product easily, and you're looking for sufficient buyers and sellers. So what South Africa has done is certainly, and our staple food, white maize. We're the only white maize futures contract in the world that we know of, and therefore really a world leader in derivative contracts for white maize, yellow maize. We also have a wheat contract, sunflower and soya. But those are instruments that you can use to manage price risk.
Okay, tell us about the variety of products on offer and the financial instruments and the financial pricing products that have been put together by way of drafting these agricultural derivatives. Basically what I'm asking is, how does it work?
Yeah, when you look at, what is a derivative market, how does it work? Derivatives all started in commodities way back, and it was really the market was looking for a mechanism to manage price risk, okay, and also to have a method to be able to guarantee that process. So when you talk about hogs and things like that, it all really started back in this debate. Everyone seems to think it started with trading of rice, and the rice farmers trying to find a method, how do we manage price risk? We're going to produce a product, and we have no idea what we're going to get for the product when we harvest it. And so really, very simplistically, the futures market or the derivative market is a platform, a trading platform where willing buyers, willing sellers get together and trade into the future. So they're trying to lock in a price that will be available at harvest time or a few months down the line.
Let's talk about the reality of farming, because it's seasonal, hence we're talking about harvesting, but it's also vulnerable to a variety of factors, ecological factors. The harvest doesn't quite come up with the crop yields and the volumes that you were looking at because of a drought or whatever other factors. And that creates price sensitivity and price volatility. How do you protect against that kind of risk? Because it's inevitable within the agricultural sector.
I think if you look at production risk, it's been with us since the start of time. As you mentioned, is it going to rain? Is it going to rain too much? Where derivative markets, really this is an instrument to manage that price volatility that you're talking about. How do you do that? You look into the market is trading forward-looking contracts. So today you could see what the July 2010 price is. Before the farmer starts to plant his next maize crop, he can look to a derivative market as a price signal, as a price indicator. Can I produce at the levels where we're trading for next year? Is it profitable? How do I get to go about and manage the volatility? And it's really using the derivative market, trying to lock in a price, and that is then guaranteed when you harvest to be able to secure that price.
You're going to sell at that particular level. Now, what are investors' approach to this particular agricultural derivatives market?
We've certainly seen a shift over the years where more and more financial investors have seen the benefit and the potential in commodities. And particularly the international benchmark is really Chicago Board of Trade. I'm talking about grain markets now. And yes, there's a hot debate about speculators and hedges, and do speculators drive the market? But as far as investors go, certainly there is appetite more and more for commodities, and that's really seeing potential. Do we think commodity prices are going to go up? As an investor, I will buy the product. But with derivative markets, unlike a stock market, if you believe that the commodity price is going to fall, you can then go and sell the commodity, sell the futures contract, and try and benefit in that sense. So certainly, as I think the potentials and opportunities exist in commodities, you find more and more investors moving over. It all just depends where the opportunities lie.
How does this impact on averting things like food inflation? Because you'll remember, middle of last year, pre the Wall Street crisis, we had a food crisis by way of speculators speculating on rice, speculating on wheat. It pushed up the price of these grains to the point where people in countries that use these as staples couldn't afford it, and it had a social impact just by way of civic unrest in Indonesia, in Egypt, in Senegal, for instance, to what extent does an agricultural derivatives market help to avert that kind of thing, or in fact, does it do the reverse, fuel it? Because you're looking at future prices without necessarily considering the current crop yields.
Lerato, I think the jury is still out if the speculators were the cause for that commodity run that we saw last year. I think there was a number of factors that added to that price hike. Yes, we looked at higher oil prices, which meant ethanol all of a sudden became a huge viable proponent, and therefore you saw a lot of commodities going into that industry, which wasn't the case previously. So I'm not too sure if speculators were to blame for that price hike. I know there's a number of investigations, and again, the big driver has been in the US market. Yeah. I think we need to appreciate the role of a speculator and a hedger in the market. And as long as there's a good balance between the two, the markets will be efficient. A market cannot operate just with hedgers. You need speculators who will take an opportunity and trade against a hedger. But do they fuel the price hike? I think when we've looked at the higher commodity prices, there are fundamental reasons for those high prices. But the important thing is there's a mechanism for your underlying processor, your miller, could have hedged at much lower prices if they had used the market. So it's always, let's look at the other side. If you look at governments, we have examples where governments have used the derivative market in Africa to secure food prices so that they can ensure food security.
How does this help the African farmer? Because what we want to do is we want to commercialize farming and make it an economy of scale. How does this help the African agricultural industry, especially because to a large extent things like tea, for instance, are sold on international auctions, things like grain are traded internationally. It's almost as though we produce but we don't really influence the price.
When you look at a derivative market, and again, as South Africa is really the only example of a commodity derivative market, there are others that are trying to be established. The purpose there is price transparency and price discovery. So how does that help any farmer? There's a transparent price being established. Why? Because there's a willing buyer, willing seller trading every single day. And therefore that helps with forward planning. So a farmer sitting in Zambia, in Malawi, in Uganda, if they have an efficient market operating, they can make decisions based on what the prices are on the market. And therefore, yes, it takes some time before you can establish a derivative market. It is a more complex market than your standard spot market. But, and what are you looking for? You're looking for infrastructure. You're looking for some government regulation and government sticking to their regulation. If they decide on a free market, stay with that policy. So there's a lot of criteria that goes around before you can establish a derivative market.
Okay, and finally, what are the sort of challenges and competition that African farmers are facing? Because we know that China is a major consumer of grain, but is also a producer. The United States the same, and we've seen the wars over rice and corn, or maize as we call it here. Latin America and soybeans, those are also quite viable countries within the market, producers within the market, and they also operate within this agricultural derivative sector.
If you look at the potential for Africa, and that's from a soil point of view and from a climate point of view, as you move north of South Africa, the potential is huge to be able to produce a significant amount of commodities. The other countries we're competing against, they have obviously ensured they have sufficient infrastructure, they have good storage mechanisms, they have good export potentials. And that's something South Africa has to focus on, trying to build that up so that we can compete on an export basis. But as Africa goes, and you often look at, yes, there's always the story of food aid coming in and where is it going. Africa certainly has potential to produce more than its own requirements and be able to compete with the rest of the world. If you look though at Argentina, a country which has huge potential and has obviously come onto the market and supplies a lot of the commodities, soybeans, yellow maize. So South African farmers particularly are competing with these growers in other countries where they obviously have better soil conditions, better growing conditions, and then you still have the argument where we compete against the US where there is aid, government assistance, where South African producers don't have any of that. So there's still challenges, but there's huge potential for the African farmer.
Okay, and